Ethereum's recent triumph over the $2,850 barrier has reignited bullish enthusiasm, positioning ETH for what could be a significant breakout toward $1 for 1,000. But beneath the surface rally lies a complex battle between accumulation and speculation. And understanding both sides of that contest is essential before declaring the $4,000 milestone. All but certain. On the bullish side, the move above $2,850 represents a textbook breakout from a consolidation zone, signaling that buyers have finally overpowered sellers who had previously defended that level. The fact that ETH now trades comfortably above its 200-day exponential moving average on the daily chart further cements the argument that a longer-term uptrend is in place. Historically, assets that sustain trading above their 200-day EMA tend to attract fresh capital from institutional investors and algorithmic funds, which view that signal as confirmation of a structural reversal. Compelling on-chain data lends weight to this bullish thesis. On July 12th, Luke Hanchin reported that SharpLink SBET executed an over-the-counter purchase of 21,487 ETH worth, roughly $64.26 million via Coinbase Prime, following a prior buy of 10,000 ETH directly from the Ethereum Foundation. These large-scale acquisitions suggest that whales are quietly layering into ETH at current prices, anticipating higher levels in the medium term. The outflow story is equally persuasive. Data from CoinGlass reveals that on July 11th, long-term holders and institutional entities withdrew over $206 million worth of ETH from centralized exchanges. When investors pull tokens off exchanges, it typically signals plans to hold rather than sell, creating a supply squeeze that can fuel upward price pressure. Each of these moves, massive OTC purchases and exchange withdrawals and HS prospects, a necessary precursor to any sustainable rally, yet a contrarian perspective is warranted. The same period saw 3 major wallets open leveraged short positions, betting against ETH's rise with 15x to 25x leverage. According to Look and Chain, these shorts totaled 48,458 ETH to about $143.37 million backed by a mere $10.5 million in USDC collateral. Such aggressive positioning suggests that some market participants expect a short-term retest or even a deeper pullback that could invalidate the breakout. If ETH fails to hold the $2,850 zone on a retest, forced liquidations of those leveraged shorts might actually accelerate a bounce. But they could also trigger broader panic selling if key stops are hit. The juxtaposition of massive accumulation and equally massive short bets sets the stage for heightened volatility, an environment where rapid reversals are possible and traders caught on the wrong side could face significant losses, adding to the complexity. Overall trading volume for ETH has contracted by some 42% over the past 24 hours. While price breakouts on lower volume can still succeed, they lack the conviction and breadth typically seen in the strongest rallies. Low volume leaves the market vulnerable to counter-trend moves without a steady influx of new buyers, and, with significant short interest on the table, a single catalyst negative macro news, a security lapse in a leading DeFi protocol, or regulatory headlines could prompt a swift retracement. In fact, markets often consolidate after a 20% plus 3-day surge, as traders lock in profits and reassess their risk parameters. In that sense, the slowdown in volume may be a healthy pause rather than a red flag, but it does make the immediate path forward less predictable. From a technical standpoint, Ethereum remains above the $2,850 breakout level and the 200-day IMA. The upside projection toward $4,000 remains intact. A standard measured move aiding the height of the consolidation. Range roughly $1,000 to the breakout point yields an objective around $3,850, which rounds neatly to $4,000 as a psychological target. But traders should be prepared for potential retests of $2,850 or even the nearby $2,700 support, zone before ETH has the strength to tackle triple digits again. A failure of the $2,850 level on any retest risk plunging ETH back toward $2,500, triggering a nasty shakeout among weak-handed holders. Conversely, if consolidation holds and volume picks back up, particularly from institutional channels such as spot ETH, ETFs, then momentum could recommence, driving ETH toward the next supply wall near $3,200 and beyond. Macro considerations add another dimension. Ethereum's price is increasingly correlated with equities and risk assets, meaning that any shift in Federal Reserve policy or disappointing CPI data could quickly sap risk appetite. July 15th's U.S. Consumer Price Index release, for example, represents a major catalyst. Hotter than expected reading could dampen investor enthusiasm across risk assets, including ETH, leading to profit-taking or a broader deleveraging event. On the other hand, moderating inflation and dovish Fed comments would reinforce the narrative that real yields are falling, pushing institutional allocators toward alternative yield sources, staking, ETH, or engaging in DeFi strategies further. Underpinning price, longer-term drivers remain intact. Ethereum's transition to proof-of-stake and the ongoing rollouts of scaling upgrades, such as IP 4844, promise lower gas fees and higher throughput, which in turn support higher network activity. As daily transactions and total value locked in DeFi continue to climb, ETH's deflationary fee burn mechanism grows more potent. In this light, the $4,000 target is less a speculative pipe dream than a reasonable reflection of Ethereum's maturing monetary policy and growing utility. Additionally, as more institutional products, ranging from spot ETFs to staking derivatives, emerge, ETH's investable float tightens, further skewing supply-demand dynamics in favor of price appreciation. Nonetheless, the competitive landscape cannot be ignored. Rival Layer 1 networks such as Solana, Avalanche, and newer entrants have made inroads, siphoning developer activity and user adoption from Ethereum. If any of these chains achieve a breakthrough in real-world asset tokenization or DeFi composability, capital may flow away from Ethereum, despite its technical strengths. Smart money might choose faster, cheaper alternatives for specific use cases, reducing some of ETH's speculative allure. Moreover, regulatory scrutiny of staking and DeFi could introduce additional friction, potentially dampening the staking yield premium that has drawn many institutional participants. Ultimately, the question of whether Ethereum can reach $4,000 hinges on a delicate balance of conviction, volume, macro context, and competition. The breakout above $2,850 and the structural alignment around the 200-day EMA are powerful positive indicators. Bolstered by whale accumulation and on-chain outflows, yet the sizable leveraged shorts, contracting volume, and broader market uncertainties serve as cautionary counterweights. Traders and investors who recognize the depth of this tug-of-war can better navigate the high-stakes environment, templing disciplined position sizing, monitoring retest levels, and staying alert to macro catalysts. If ETH holds its breakout, absorbs the short pressure, and recharges volume, the milestone of $4,000 could indeed lie ahead. But if even one critical support zone falters amid adverse news or rapid deleveraging, the path to quadruple digits will face formidable obstacles. In crypto, as in all markets, opportunity and risk are inseparable partners, and Ethereum's next move will depend on which side gains the upper hand.